Welcome to the Human Side of Wealth. We're here with another episode, and I have my colleagues Rick Winters, partner and senior wealth advisor, and Steve Reeder, president of Private Wealth. Good to see you both.
Good to be here. Good to be here. Thanks for having us.
So today, the focus, gentlemen, is tax planning. So this is the hot topic. We had the big, beautiful bill passed last July. We had Secure 2.0 passed a few years before that. And here in 2026, tax planning is such a hot topic for clients that we speak with. So perfect time to do this episode here. We're recording this here in early March. Tax deadline is coming, right, in mid-April. But what we talk about here with clients is that's really just the beginning of real tax planning, right? April 15th is one date. Tax planning is year-round. So I'll leave it open to start, but Rick, you're working with clients here on the front lines on a daily basis. What are you talking with these folks about? What are you seeing out there from a tax planning perspective? What's new and exciting?
Well, as you mentioned early on, we've got the new OBA, the One Big Beautiful Bill Act, which is officially law. And now the fact that we have many of the rules that were put in place, the opportunities maybe you can refer to them as, to do some smart tax planning, gives us an opportunity to work with clients, make sure that we, I guess more so than ever, don't take for granted the planning that has to happen every step of the way throughout the year. I don't know if April 15th could be referred to as the end or the beginning or the middle. I just feel like, tax planning is always just right around the corner. If you look at what came out in the One Big Beautiful Bill, it gives us an opportunity to now actually do some legitimate long-term planning because we have a tax bracket system that is permanent.
Yeah, I want to touch on that word in a second. Yeah, but keep going.
And then, which allows us to focus on some big hit items, which is using enhanced deductions, making sure you don't miss out on opportunities on the charitable giving side, Roth conversions, et cetera.
Yep. Steve, how about you there? What are you thinking about?
Yeah, I think it's an interesting time with all the changes. There's a lot of things we can do right now, but I think the time of year is interesting because it puts a big focus on taxes and tax planning. And right now you get a lot of money in motion at this point. And so as we're getting returns, we're making payments, that kind of forces some decisions, which really just expand upon what we talk about all year, which is the decisions are made throughout the year. When I think about actual tax planning, I've always liked to focus on the back end of the year because a lot of the decisions we make in the back half of the year that impact what happens and whether we receive a refund or have a tax bill in April. And so it's, even though now's the time that gets all the attention, to Rick's point, the planning's really happening year round.
Exactly, yeah. So the word permanent, that's interesting, right? I think we should.
Did I do the quote?
Yeah, you did the quotes, and it's important we touch on this, right? Because so before Big Beautiful Bill was passed, right? Just to set up the context a little bit, everybody was planning for the impending sunset, right, of the Tax Cuts and Jobs Act. And what the Big Beautiful Bill did was set many things as lowercase p permanent, such as tax brackets, as well as other things.
Yep.
Why that's important is that another Congress could come along and change this, right? So it's still important that we're kind of saying that permanent until change, exactly. Which means, why is that important? There's still opportunity now, right? Tax rates are at historical lows, right? It doesn't mean they're going to stay that way forever.
That's right. And most people don't think about it that way because you think like, 37% on the high side, which most folks are not dealing with, even if you do have a sizable portfolio. I mean, we're talking about for a couple, like upwards of $700,000 plus before you hit that bracket. And that assumes that you have no other things to offset with deductions or opportunities to make contributions. So really understanding that today's tax rates are significantly more accommodating than they have been since original introduction of taxation on payroll taxes. So big point. But permanent, yes, until someone changes it.
Yep. So, and Steve, you mentioned money in motion. Potentially refunds are going to be larger here as folks get to file their returns, get checks back in 2026, because as this law was passed, it was in effect for 2025, right? So one example that we've talked to clients about is the higher state and local tax deduction, that being raised to $40,000 from $10,000. So we'll dive into that more maybe in a minute. But as you think about, Steve, from a cash flow perspective, refunds coming in, being larger, how do you think about that as part of someone's overall financial plan?
Yeah, it can help fill some gaps for individuals depending on their situation and what their goals are. Getting that excess cash that maybe they weren't expecting can help fund other goals that maybe they neglected to fund or wanted to fund. I mean, some people turn it into a charitable gift. There's a lot of things you can do with it. But what I love about it is it gives optionality. And so I think for our clients, that's the biggest thing we want to do, is give optionality. And by great tax planning, we can predict a little bit more what we're paying, when we're paying it, and just optimize the tools that we have.
Yeah. Let's pull on the thread a little bit more on the difference between tax prep and tax planning, because I think this is a fine point that I think we should really underline. I know we've talked about this quite a bit, but I think it's important to really distinguish those two things.
Yep. So tax prep is what happens on April 14th, hoping that your filing is not late for April 15th. In the majority of cases. I know that's the case because we're usually sending out, tax documents that have been misplaced, or accountants searching for one missing account on the end of the week. But tax preparation is meeting in January to decide how we're going to handle the year's planning, because it's a lot better when you're dealing with taxes overall when you feel like you're actually in control of your bracket. Like you're actually deciding how much tax you're going to pay that year, versus it just being in April 15th and the accountant shows up and says, hey, you're 10,000 short on your tax bill, or hey, I'm sending you 10 back because we never talked about it. So tax planning gives you a lot of opportunity to take control of what you otherwise feel is potentially chaos, especially as this most recent bill has made things even more complicated.
And planning's being very proactive about it. We had clients, and this happens often, they retired. And we often look at how do we pay the least amount of taxes. And when you think about the least amount of taxes, that's not necessarily the least amount of taxes this year.
Right.
And so when someone retires, they may have some years before they have their RMD, which was the case for this couple. And so we actually talked about, let's create more income now, which we had the ability to do. And that sounds counterintuitive, but we wanted to take advantage of those lower tax bracket years. And so when I think about planning, it's strategies like that are really, truly very intentional, that may seem counterintuitive, but when you look at the big picture, it's actually going to save them a lot of money in taxes over the life.
Can I give an example there?
Please.
So just to kind of put a little bit more behind that, is the rule is pay the tax when it's least.
Yes.
Okay? Just to give us a simple definition,
When your
you leave.
rate is the lowest.
If you pull nothing else out of here for tax planning, just pay your taxes when they're the lowest. But that doesn't mean always try to get the lowest rate, because you may be looking at significantly larger rates in the future. Where that tends to show up most is, let's say someone retires more traditionally at age 65. Why? Medicare kicks in and you have insurance coverage, and you're starting to think about Social Security. But also at that time, you could delay Social Security till 70, and your required minimum distributions from the retirement accounts don't kick in until 75 for anyone under age, mid 60s right now. So that leaves us a window where you're literally pulling every lever on every dollar worth of income that you produce. And so when we sit there and go, hey, let's move up and take full advantage of 22%, you're like, wait, I'm paying 0. Yeah. I'm like, no, we're gonna pay 22. Why? Because if we leave it just sit there, you may be paying 37% at age 80.
Yes. Well, we see situations where potentially with a prospect, right, we're looking at a prior year's tax return, and maybe they're very happy with the fact that they paid nothing in taxes last year, right? This is a good thing, right? Well, maybe not, right? Because to your guys' point, the goal is to smooth out your tax pain, maybe we can call it, over the course of your lifetime, right? So one thing we talk with clients about is this concept of a lifetime tax bill, not just your 2025 tax bill or your 2026 tax bill, right? So our goal as advisors is to lower that number, right? That's what we're after, and we have helpful tools to be able to visualize that, and we'll get into that in a bit. But Rick, wanted to ask you, as we think about just the conversations that people should be having when it comes to taxes with their advisor? What do you think stands out?
Yeah, so if you, where I spend the most time is when we are trying to let the portfolios kind of live and do their thing. We're looking at the dividends, the interest, the capital gains that are being generated. And so when somebody needs money each month and needs, has a bigger item, a big expense coming up, within the portfolio, there's a lot of opportunity to, see if we're going to be able to get the portfolio's natural income from it before we go in and just start trading things because you called me, 3 days before and said you need a larger sum of money. We like to be able to do that with advanced planning. If I'm going to go where everybody's trying to, should be paying most of their attention, it's really in that, what are the things I can do on the small side of my IRA contributions, Roth contributions, that has not changed. Mm-hmm. What am I contributing through my employer's plan? This is just table stakes. Yeah. What are my options within those plans to go to the annual exclusion amount or my annual deferral? Or can I go even further with after-tax contributions, and what am I going to get from a match? Yep. But also, one thing we didn't really talk about here, and I don't want to just get totally hung up as if taxes are all because of payroll or your investment portfolio, but things you can do on the charitable side, which has changed a little bit for some, actually both on standard deduction and itemized deductions, which I'm assuming we should spend a minute on.
Let's talk about that. Yep. Itemization maybe matters again, right? So I was looking at some statistics before. So before Tax Cuts and Jobs Act, about 30% of taxpayers were itemizing. After that was passed back in 2017, so that of course that doubled the standard deduction. So that cut itemization down to around 10-ish%. Now, with the state and local tax deduction being boosted to $40,000, itemization maybe matters again. What are you guys thinking about there?
Yeah, I think the other thing that we're seeing is some of these mortgages are rolling over. Yep. People are finding themselves in 6.5% mortgages versus 2%, which creates it. So it's definitely a conversation we need to have more and more with the changes that have happened. We're seeing people that it makes a lot more sense for. Another one of those things just to pay attention to. Everyone's situation is a little different. Rick, I don't know if you're seeing anything.
Yeah, well, I mean, those are new, and so the phase out is the big issue, is because you have a certain level of income, which is not in, it's a substantial amount. Yep. Like it's still, you're still seeing the phase out between that $500,000 and $600,000 range on a joint, and roughly half that for singles. So if you come in and you're at $601,000 and you had an opportunity to knock that down by $60,000 when it came to how the calculation was being done for what you could deduct on your state and local taxes for itemization, that would be a problem. Like if you just went in blind and did it and just made a conversion that ate all that up and didn't go even further to make it really worthwhile. I know I'm using some general terminology here, but the idea of going further is how much more income could I have realized now that I already missed out on that deduction, versus like, oh, I don't want to go any further because I'm going to lose that deduction.
Yes. Well, there's this kind of underlying thread here of it's becoming, I think, more complicated to visualize and understand, what your tax burden actually is. Because when you're talking about phase outs at different income levels and losing out on really big deductions, it's not only your marginal bracket that matters, but it's actually your effective rate, which if you're looking at your 1040 that your accountant gives you, good luck figuring that out. That's a very difficult thing to do.
Effective rate being the average rate that you pay.
Yes, exactly.
Yeah, I would say though, it's funny because with complexity actually comes opportunity too. Yeah. And so again, with the intentional tax planning in place, all the complexity gives us more opportunity. So let's, one other thread I was going to pull on that is if you are itemizing, it opens up charitable gifting as well, another lever we can pull. So with the complexity, it gives you so many more options to think about. And I think when I think of tax planning, I think it's how you truly manage your wealth. at the end of the day. When you have an investment strategy in place, you're trying to grow your portfolio. But with the tax planning strategy, you really want to maximize those dollars, and you can maximize them with great tax planning. And again, the complexity, though it can be a pain, it actually does offer a lot more opportunities for us to do some things that can help our clients.
I'm going to give you some credit here. I've heard you say this in a number of different ways, but sometimes it's our job to simplify the complex. So what may be generally referred to as complex is when we're having fun.
Yes.
Because we're in a position where we can advise on some client. You don't want to go there. That's fine. We don't need to do, take advantage of every turn because of every opportunity. But we do want to make sure that that is on the table to be considered.
Let's talk for a second about, how we do that. We don't have to get too into the weeds on how we simplify the complex, but we have some tools that allow us to help a client visualize what they're paying in taxes, what opportunities there may be.
There's a lot of different tools out there. We've built and been able to use a number of things that we've built internally and use from outside resources to, what's one of the first things that we're asking for when we know that we're really going to be helping this family or individual is hey, send us last year's tax return, because that's actually going to tell us right out of the gate what already exists. And because, technology is a wonderful thing when used properly, allows us to kind of meter what else can we do within your tax planning to try to maximize maybe taking advantage of that low tax bracket while still pushing your income and not missing out and triggering IRMA and losing out on the enhanced deductions and canceling out SALT deductions. So, but on the planning side, which is really where we build out your base plan, which is so important because that's when we, you have an investor or planning client, a client that we're working with is looking to think through a couple options that they may have available to them, that we would be able to model that out for them using our assumptions and the knowledge that we have from years of experience of working with other clients.
Well, what I'm thinking is, can we do a lightning round?
Yeah.
Quick lightning round on different segments, right? So again, we won't go too deep into the weeds here, but I was thinking it might be good if we hit, if you're in your mid-career accumulation phase, if you're retired, you're in the kind of that phase, you're drawing from your portfolio, and then maybe just for a quick second, business owners. I know that's its own thing, but we'll touch that. So what are you guys thinking about, tax opportunities if you're in that, accumulation stage of your career, maybe high income years? What are you thinking about?
Okay. So I'm always glad to take the floor. So so as if somebody that's looking to accumulate, absolutely first things that we're asking for is every bit of detail regarding your benefits from your employers. Okay. Obviously understanding what mortgages may exist or what mortgages may exist ultimately, currently or in the future. So we can get an idea of where the dollars are going to be directed. Then when somebody's still trying to build, maybe they're planning around education. And then we're talking 529 plans or other now Trump accounts.
Yes.
Which will probably be a podcast in and of itself. If you're in that situation, you've got a lot of bills that you have to pay now. You have a lot of bills that you're going to be paying in the long run. So manage how you go about building out your lifestyle. Make sure you take advantage of every opportunity that's available to you to save and reduce your taxes, or position money that could be taking advantage of a low tax rate now and position you for lower tax rates later. I don't know. I don't want to. I get lost in that one.
No, there's a lot you can pick from. I know charity is a big one that you bring up in this.
Yeah, I think for this group, though, when you think about those that are still accumulating, often they live relatively paycheck to paycheck. Not always, but there's a lot of expenses.
Sure.
And when I have a couple young children of my own, you feel like you're tied to your budget. And so I think it's taking a step back and just assessing it, doing some planning, because there are options out there. But I think the problem most people do in that is they get overwhelmed and they don't do anything. And I think that's the biggest problem.
Yeah. All right. How about folks who are in retirement, nearing retirement? Maybe they're eligible for the senior deduction as part of the Big Beautiful Bill. or the OBA. The OBA. You called it the OBA at
we
the
can talk
beginning.
about retirement as a whole subject in
Yeah,
itself.
I know.
Retirement. Listen,
Give us the quick hits.
So nearing a time when you would be either making no money or less money.
Yeah.
Okay, and that actually is a fun time because you know, as you're talking through what are the longer term priorities, what are the things that you would like to see happen within your portfolio, how you want to be able to position it. That does give us the opportunity to focus in on how we're going to generate that income. But because of that ending point or reduction in income or stopping income gives the opportunity to really focus in on that converting of IRAs to Roth. Why would we do that? Because if I can convert some money to it from an IRA today at a certain tax rate that's we know is going to be lower than a future tax rate, then I'm not only growing that money that's now in the Roth account tax-free, I'm also positioning it to be able to give it to as part of my legacy if there's money left in there. And that is a game changer when it comes to trying to reduce future tax liability. But it also puts us in a position where you can take advantage of this new enhanced deduction for seniors. So if you're over 65, you get access to a $6,000 per person. That is in addition to the already existing standard deduction per couple. That's $31,500 in 2026. Oh yeah. Got to keep updating those numbers. So that's now putting you in the $40,000+ range before you even consider what your income is. So like if you had Social Security and some pension and that was close to 100,000, you just cut it in half by that. So as a early retiree, and then you have Medicare obviously, and the IRMA.
That's a stealth.
That used to be the one we paid most attention
to. That's a stealth tax.
Yep, the stealth tax.
Yep, as we like to call it.
So don't be naive to the fact that you think you got Medicare and it's all one price. Yeah. So if we go and generate a bunch of income, you might be paying a lot more in Medicare. So you got to factor that into your planning as well.
Yeah, and you hit a lot of the topics there for sure, but I think of it a little bit too as just like strategically, what are you trying to accomplish at that point in your life, which is you need to look forward 10 years, because I think the trap people that are nearing retirement is they think they can't make changes or get ready till post-retirement. And when you think about what you're gonna need after retirement, income, where's your money coming from? How are you spending those bills? So asset location starts to matter a lot. If you get into retirement and all your dollars are qualified dollars inside IRAs and 401ks, you have to account for that tax. So if you have if you're pulling out $100,000 a year and it's coming from your IRA, it's going to be significantly less than $100,000 a year. So starting to think about asset location, any changes you can make. I start thinking about even the investment management positioning of where they are, and are we in the right things that are going to produce income? Do they need income? How much income are they going to need? And so just starting to plan a little more accordingly for what is 10 years out going to look like? What's the post-retirement look like? Because it does take time to make that transition if you're going to do it properly.
Right. Yeah. I mean, asset allocation. Right. What makes sense from a equity to fixed income mix? Okay, we agree on that. Now, how do we accomplish that asset allocation? Where do we locate? Certain
pre-tax,
exactly,
taxable,
in different types of accounts, right?
Yep.
And that can occur. I'm really glad you said that, right? Because that's also becomes important in the accumulation phase too, right? Those are the things that show up, 20 years later, making sure you're on the right track there. One or two sentences on business owners. I know we were doing some prep for this episode before, and we said, man, do we even have time? What do we say? This is a whole episode unto itself.
Well, some of these things are already available, but now there are things that have carried over from Secure 2.0. Most people don't know that if you're self-employed, you have the opportunity to save a significant amount more than someone who may be just working with, a W-2 paycheck through an employer that may be limited to just being able to put, which is still a large sum, as their annual deferral into their 401k plan. But someone who's self-employed has the opportunity to go up $70,000+ depending on their income and how the plan is established for them, especially if it's just like a couple, two spouses. There's an opportunity to do it for both within these plans. There's also the 199 Cap A, which came out of TICJA, I think back in 2017. QBI, which is, if you don't know what those are, don't worry about it. If you do, you've already been dealing with it. Those have been enhanced even further. So don't take any of this for granted. If you think it's just, send this stuff off to the tax guy or preparer at the end of the year, make sure you're diving into, that everybody's up to date on these new rules.
Yeah. Yep. Things can get missed.
Absolutely.
They do all the time.
Yeah.
Not from our tax team.
No,
right.
right.
But it's another same comment of the complexity that's created is a lot of opportunity.
Yes.
So anyone that owns a business understands being able to deduct a lot more things than maybe someone like ourselves who work for a larger firm, W-2 type employee. So that complexity, you got to make sure you do it right. You have to make sure you have the right people at the table, the right advisors you're working with, the right tax advisors, financial advisors. So for people with small businesses, there is so much opportunity, but there's a lot of landmines you can step on along the way as well.
That's well said. So yeah,
There is one thing that we missed.
Okay.
It's the estate planning.
Ooh. Yeah.
Because of the with the rule. I don't know how we missed that because that's it's
Yeah.
like 90% of the motivation on some things is, but related to the annual exclusion.
Yes.
Or sorry, the estate tax exclusion, not the annual exclusion. There is an annual exclusion which you can give $19,000 in 2026 to anyone that you care about.
You've got all the numbers.
You can bring them together with a spouse to do a gift split for $38,000 to anyone, and if you do, it doesn't not limited to one person, but anyone you want to. Then, if you were to, have an estate of 20 million to 30 million, and you and your spouse had passed away yesterday, you would have a full exclusion on that of $30 million, 15 each. Over that, you face a tax of 40% on the federal level, and state has their own estate tax. That's not what I'm talking about when I get to this $30 million number. I am specifically talking about the federal estate tax exclusion. There's a lot of planning that plays into how you handle your ownership of those assets, getting to that point when you do pass away and need to pass on these assets to your heirs so that you can try either through giving it to them early or involving charity or other interests that you have, so that the day that you pass away, you're not over $30 million, at least at the current level. It is adjusted for inflation as well.
Yes. Thank you for bringing that up.
Yeah.
Do you have something there?
Oh, I was just saying the estate plan. I think though the one thing that I don't want to lean too much into, maybe debunk even. I'll say, but it's not just 30 million and above that we're worrying about. And I think too, like estate planning is a very personal thing for most individuals, and not everyone wants to talk about that. But they still have people, charities, different institutions that they want to take care of along the way. And so I think it comes down to being proactive in that. Do you want to give the money now or later? Do you want to see the look on their face, or are you okay passing it after? The term that I've always connected with me and I've heard for many years is, do you want to give your money with warm hands or cold hands? And I think it does put a certain spin on it to understand, like, you do have a choice, you have a decision. A lot of people we talk to are afraid they're going to run out of money. And I think having an advisor that you trust and really getting in depth on that will help build the confidence for you to act on some of these before you pass.
Yeah.
And so I think getting to help your grandchildren is something that a lot of people we talk to care about, and they're afraid to do it because they don't want to run out of money. They don't want to become a burden. And if we can get a plan in place and show them that they can give away a certain amount, like, I think it proactively allows people to live their dreams a little more, to help the grandkids, to do things they care about.
Right. Well, there's this concept of you've got income tax during your life, and then planning for transfer taxes, as you mentioned. I will say my hands have been freezing in the winter, personally. But I like that point: warm hands versus cold hands. So, all right, what did we hit? We talked about tax planning versus tax prep. We talked about conversations you should be having with your advisor. We talked a little bit about lightning round for different segments, depending on where you are in life. What would you leave the viewers and the listeners with as we wrap up this episode?
As you should with all things really, is have a plan, and maybe it's as simple as just having a schedule with the advisor that you're working with to know that at certain times of the year you're having certain conversations, and not missing out at around that September, October, November timeframe to have a tax-specific meeting so that you don't get to December 31st and figure out that you missed a tremendous amount of opportunities. So thinking ahead. Taxes are always around the corner. It's not just April 15th. It's not just December 31st. So yeah, be prepared and have the conversation. It can actually be fun. Yeah. Like when you start figuring out how much money you're saving sometimes.
Look at us. We're having a great time. Yeah.
They say there's two things you can't avoid. What are they? Death and taxes, right? And I'm here to say, like, I don't disagree that you can't avoid taxes, but you don't have to succumb to them. You don't have to be submissive in the relationship you have with taxes. Like, take control back. There's a lot of things you can do. We can minimize taxes. So whether you can or can't avoid paying them, you can minimize them, but it takes a lot of intention to do it. So just make sure you're not sitting back thinking they come to you, you have to pay them, there's nothing you can do about it. There's always something you can do about it. It may not be this year, you may pay more this year to pay less over the lifetime, but planning does minimize taxes for the large majority of people that really lean into it.
Well, Steve and Rick, that is a great way to end it. And thank you, the viewers, for watching another episode of The Human Side of Wealth. Tax planning is complicated. It's hard to get right on your own. If you have questions about your own situation, please don't hesitate to reach out. We would be absolutely thrilled to help you lower your lifetime tax bill. Thanks again for watching.